to this weekly installment of the Whitaker-Myers Wealth Managers, What We Learned in the Markets This Week. My name is Summit Puri. I'm the Co-Chief Investment Officer here at Whitaker-Myers Wealth Managers. Thank you so much for tuning in. As usual, this week we'll discuss 4 key focus points highlighting the key learnings from the market activities in the past week. In point number 1, we'll do a market recap with our key market indicators. In point number 2, we'll take a look at the ISM manufacturing and services data. In point number 3, we'll talk about jobs, really focusing on the non-farm payrolls and the unemployment rate. And in point number 4, we'll talk about market volatility and portfolio rebalancing. So with that, let's hop right in. And now on to point number 1, the market recap. First, each week we review the Atlanta Fed seasonally adjusted GDP Now report to gauge in real time how fast our economy is growing. This week, the Atlanta GDP Now report shows a projected negative 2.7% growth as of April 3rd, which is down from last week's negative 1.7%. Next, each week we look at the initial claims for unemployment insurance for a gauge into the front end of our labor market. This week, initial claims data fell by 5,000 claims, ending at 219,000, while continuing claims rose to 1.903 million. The continuing claims mark is the highest value we've seen since the pandemic. Next, we are watching mortgage rates closely to see how home affordability is trending. This week, we saw minimal movement again in the 30-year and 15-year mortgage rates, ending at 6.64% and 5.82%, respectively. Moving on, next we'll take a look at investor sentiment. One component of investor sentiment is the measurement of the bull to bear spread. The latest update shows the bull to bear spread fell from negative 24.73% last week to a negative 40.16% this week. Investors are still continuing to feel quite bearish with the current market. Another measure of investor sentiment is the VIX, or the volatility index. Generally, the VIX rises when stocks fall and declines when stocks rise, often showing an inverse price to action relationship to the S&P 500. We saw this in real time this week. VIX values above 30 are typically linked to large volatility resulting from increased uncertainty and fear, while values below 20 generally correspond to stable market periods. This week, the VIX ended at 45.31, highlighting very high uncertainty and fear in the market. The latest VIX values are the highest we've seen since April of 2020. Next, we'll continue to update you all on the Fed rate cut probabilities based on future contracts. Currently, the CME Fed Watch tool is calculating a 33.3% probability of a 0.25% decrease and a 66.7% probability of no decrease in May. And finally, let's take a look at how the markets ended. Last week, the S&P 500, which is our proxy for growth and growth in income, but only when considered together, ended negative 9.56%. The Russell 2000, which tracks small and mid-sized companies or aggressive growth in our Dave Ramsey vernacular, was negative 9.18%. And the MSCI EAFE, which tracks international stocks of developed countries across the globe, excluding the US, was negative 4.94%. As you can see, the much-awaited April 2nd date came and shook the market. I believe that the vast majority of this fall is fear and sentiment driven. The impact of Trump's tariffs on earnings, world trade, and consumer prices won't be felt immediately. Even more, since the data lags, we won't be able to calculate the true impact for some time. So it's important to highlight here, first and foremost, that you really need to focus on your portfolio and your goals and what you want to focus on for the long term. So, number 1, if you have concerns, schedule a call with your advisor. Number 2, don't panic. Talk to your advisor, explain your concerns, and listen to what they have to say. They know your portfolio in and out, and if you need to make changes, listen to their recommendations. Number 3, don't sell. Remember, it isn't a loss until you sell. When you sell your positions, then you've locked in those losses. And number 4, this one may be tough, but avoid the noise from the media. There will be certainly some quote-unquote gurus out there that will pop up on your feed to share some recommendations. Please, please, please don't believe everything they say. Listen and talk to your advisor. Remember, we watch these market and sector fluctuations weekly to show you in near real time not only how the markets are performing, but the importance of diversification. Nearly every week we have a new leader. Appropriate diversification decreases your risk while exposing you to the upside. Now, if you'd like an unbiased review of your portfolio, don't hesitate to connect with one of our advisors today. On to point number 2, ISM manufacturing and services data. The March 2025 manufacturing ISM report on businesses indicated that economic activity in the manufacturing sector contracted with a manufacturing PMI registering 49%. This is a decrease from February's 50.3%. This contraction followed 2 consecutive months of expansion and a prior 26 months of contraction. Several key indices reflected this downturn. The new orders index contracted for the second straight month to 45.2%. The production index dropped back into contraction at 48.3%, and the employment index moved further into contraction at 44.7% as companies continue to release workers, often through attrition. The backlog of orders index also contracted at a faster rate, registering at 44.5%. The slip into contraction was primarily driven by uncertainty surrounding impending tariffs and rising tensions with trading partners, potentially leading to reciprocal tariffs. This uncertainty and implementation of tariffs caused demand and output to weaken, while inputs such as supplier deliveries, inventories, prices, and imports expanded. Prices surged further into expansion to 69.4%, largely attributed to tariffs, which also contributed to new order placement backlogs and supplier delivery slowdowns. The growth in inventories was seen as a temporary measure to avoid tariffs. On to point number 3, non-farm payrolls and the unemployment rate. The U.S. labor market saw total non-farm payroll increases of 228,000 jobs in March, according to the BLS, or the Bureau of Labor Statistics. The unemployment rate also edged up to 4.2% from 4.1% in February. Job gains were notable in healthcare, social assistance, and transportation and warehousing, with retail trade also seeing an increase, partially due to return of workers from a strike. However, employment figures for January and February were revised. They were revised downward by a combined 48,000 jobs. Despite the increase in the unemployment rate, the labor force participation rate also increased to 62.5%. In March, the March jobs report, while showing stronger than expected headline numbers and a stable labor market, came against a backdrop of significant economic uncertainty due to President Trump's announcement of new tariffs. This policy move has intensified fears of a global trade war and potential damage to economic growth. Although the jobs report initially eased some fears of an immediate softening in the labor market, the market's primary focus quickly shifted to the implications of the tariffs, leading to a stock sell-off and investors seeking safer assets. While the report shows that the labor market was still adding jobs, it's important to understand that the data is backward-looking and does not reflect the potential impact of the new trade landscape on future hiring decisions. In point number 4, I'm going to introduce our advisor spotlight. So in our advisor spotlight today, and to be honest, the timing of this couldn't be any better. I've had the wonderful opportunity to interview Barbie Cypers. Barbie is our one and only trader at Whitaker-Myers, and she provided a lot of great insight in this discussion. So this discussion really highlights why rebalancing your portfolio is not only something you should do, but it's a necessary tool that could help maximize your returns. And specifically, since we've seen so much volatility and sell-off this week, I urge all of our listeners to watch this next segment and listen closely to understand the process. I think it's very important to understand this because it can impact how you make decisions and certainly understand how we make and manage your portfolios as well. So with that, let's hop into this discussion. Welcome, everyone, to our second Advisor Spotlight. My name is Summit Puri, and I have the great pleasure of bringing our very own Barbie Cypers to this weekly video series. Many of you may already know this, but Barbie has a superpower on our team, and she's not one of our advisors. She is our one and only very talented, very detail-oriented, and well-loved in-house trader. Welcome, Barbie.
Hi, Summit. I'm glad to be here.
Well, we're so glad to have you. So, Barbie, before we jump into our discussion today, can you introduce yourself to our viewers and tell us a little bit about yourself?
I'd be happy to. As Summit said, my name is Barbie, and I'm the portfolio trader here at Whitaker-Myers. I'm married to my husband, Michael, and have three boys, Noah, Logan, and Landon, as well as one daughter-in-law, Ashley, along with two grand puppies that are wonderful. My career began about 35 years ago when I started in finance as a bank teller right out of high school. After my husband and I married, we moved to North Pole, Alaska, where I worked in multifaceted lending in credit unions and finance companies. We eventually moved to Texas, where my husband attended chiropractic school and he completed his doctorate in chiropractic there. And I designed and implemented a home equity lending department in a large Dallas, Texas credit union. After moving back to Mansfield, we went into small business ownership and started our own private practice, healthcare office. I ran the business and the daily operations until 2022. And then most recently, I was a staff accountant at a large local accounting firm until coming to Whitaker-Myers. My background is a little grassroots, but has equipped me well for the fast-paced detail oriented trading position that definitely keeps me on my toes. And I love what I do, but more importantly, the people I work with.
Oh, that's great. We're so glad to have you, and thank you so much for sharing that. I know our team and our clients really appreciate all the work that you do. So, with that, why don't we just hop into our discussion for today? So, today's topic is very, very important in today's environment, and that is rebalancing your portfolio. The question is your investment portfolio working as hard as it should, and is it in the right risk parameters that fits your needs? If not, it might be time for a little tune-up. Today, let's talk about why rebalancing your portfolio is a smart move and how we can keep track of and how we can keep you on track of your financial goals. So let me hand it back over to our expert, Barbie. So Barbie, what does rebalancing mean to our listeners?
Sure, happy to talk about that. Rebalancing means adjusting the mix of assets in your portfolio, like stocks, bonds, and other investments, to maintain your target allocation. Think of it as recalibrating a scale to keep things even. Over time, market movements can throw your portfolio out of balance. Maybe your stocks outperform and now take up a bigger slice of the pie. While that might sound great, it also means you're taking on more risk than you planned. So let me add some numbers to the example. I'm a numbers person. As mentioned, rebalancing allows the investor to stay within the risk parameters that they've outlined with their advisor. So if I've agreed to a 60-40 split, 60 being the equity portion and 40 being the fixed income, and the stock market grows significantly, which is, yay, that's what we want, my portfolio grows to maybe a 75-25. This would make it riskier than I would want it to be. So rebalancing allows me to get back to my original 60-40 split. But more importantly, my portfolio is balanced to fit my risk profile.
That's a great example, Barbie. Everyone's risk ability and risk capability differ. Making sure that your portfolio stays within the parameters that align with your goals is crucial for success. All of that to prevent what's called "quote unquote" style drift. To our viewers, that may be a term that you may be unfamiliar with, and so let me explain that to you. Style drift refers to the difference between the current allocation, and in Barbie's example, a 75 or 25 equity to fixed income ratio, versus the agreed to allocation of a 60-40 allocation. And that's a 60% allocation to equities and 40% allocation to fixed income. Now, the style drift here is, as you can imagine, is the overexposure to equities. Now, back to rebalancing. At the core of it, it sounds like when a portfolio is rebalanced, we sell high-performing assets and buy low performing assets, improving ROI. Buy low and sell high is one of the key mantras of the stock market and really one of the best ways that we can get value. So, Barbie, can you share with our clients how we make sure that all of our clients are within their defined parameters to really avoid style drift?
Of course. As you can imagine, managing daily fluctuations of all of our clients' portfolios can be a little arduous and nearly impossible at times. But this is why we've implemented a model framework along with the technology platform that gives me the visibility I need to address the portfolios that need to be rebalanced. Our investment leadership defines the parameters, and we monitor the tolerance of the asset allocations within those parameters. So, for example, we may set a 20% tolerance band on a specific security, like the stock, an ETF, a mutual fund, or fixed income. So this means that the percent allocated to that security should not exceed plus 20 or minus 20% of the defined baseline. Once it does, we're notified, and I work through the rebalancing procedure.
That's so great. So the tolerances at the security level and at the model level signal when we need to make changes. That's really great that we've talked about integrating with all of this platform and giving you better visibility with utilizing technology. So Barbie, we've alluded to this a little bit in the conversation, but can you share what are the benefits of rebalancing your portfolio?
Certainly. Rebalancing helps you really in three main areas. Number one, you maintain your target risk profile. By sticking to your intended allocation, you avoid overexposing yourself to a single asset class. Number two, you lock in gains. Selling assets that have grown can secure profits and reinvest them elsewhere. Or as some had mentioned earlier, buy low, sell high, get a piece of the pie. And number three, stay disciplined. It prevents emotional decisions, and it keeps you aligned with your long-term strategy. So this way, when the market fluctuates, and we know it's going to, the investor's not rushing to make changes that may have a long-term unfavorable impact.
That's really, really important. Thank you for sharing those, Barbie. Now, when you're looking for trades or looking at trades and rebalancing, can you share some of the areas of consideration that you review before you rebalance?
Yes, absolutely. Depending on the type of account, we make sure we have the appropriate plan in place. So for brokerage accounts, there can be a tax implication with trades, and thus we make sure that we limit the trades based on the client requirements. For tax advantage accounts, we can make necessary trades without any tax implications. But in all cases, we monitor each trade for cost and fees as we are a fiduciary and want to provide the best value for our customers.
Really, really well put. So we've talked a lot about the process and understanding the why and what behind the process. Can you share with our viewers how often they should consider or how often we rebalance their portfolios?
Yeah. To answer the first part of your question, the great news is that if you are a Whitaker-Myers Wealth Managers client, this is not something that you need to worry about. Our team of experts are highly engaged in the management of your account. As mentioned, we leverage an advanced software platform to support every client, and we're able to monitor each account closely every day as needed. And then to answer your second question, Summit, many studies have shown that rebalancing a portfolio too frequently may have more detrimental effects than benefits. You don't need to rebalance every day or even every month necessarily. Most academic research suggests doing it quarterly or annually, or what we found is that once the tolerance bands have been crossed, this trigger is the most appropriate for client risk tolerances.
It makes so much sense. So thank you for sharing that, Barbie. I, along with our whole team and viewers, greatly appreciate all the work that you do to manage our portfolios. The attention to detail and due diligence you have always shown is a great asset to our team. Not to mention the knowledge you bring. Any last parting words for our viewers before we close out?
Um, Rebalancing your portfolio isn't just a chore, it's a powerful way to keep your investments aligned with your goals. By doing it regularly or having a team manage it for you, you can manage risk, stay disciplined, and maximize your chances of long-term success. So take control and make sure your portfolio stays in tip-top shape. Lastly, invest wisely, stay balanced, and you will achieve your goals.
Thank you for that. And that, friends, concludes our discussion for this week. Thank you once again for tuning in. If you find this information helpful and informative, please take a moment to hit that like button below. By hitting that like button, you help push our content out to other viewers and listeners all across all of our social media outlets. If you'd like to see our latest videos on your feed, including new content released by our team, make sure to subscribe below. Also, if you'd like to meet with any of our financial coaches or advisors, please click on the link in the description below to schedule a meeting. Once again, thank you for watching. We look forward to seeing you next week.